Happy Friday, everybody. And for me, it's a very happy Friday. It's been a crazy long week, a lot of growing I'm doing this week. Um, Experiencing some growing pains, but with joy. Um, so, got a lot to go over this, call this Cleanup Friday. There's some things I said this week that I'd like to, uh, sand down the edges on and kind of smooth it out a little bit. So, anyway, my daughter came home from work yesterday, and I kind of was, trying to search for some feedback. And she suggested that I try to incorporate more information for those folks who are not really traders, who want to become traders. Um, y'all are in my mind, but really, I am gearing this journal towards folks that have a little bit of trading time under their belt. They have had some back testing, they've watched some YouTube videos, so forth and so on, but they still don't feel like they have a grip, much like myself. So I'm still doing things that are market structure wise not the best thing to do. So that is one of the main reasons why I don't call myself a teacher. Okay, this channel is a journal. And as I'm going through this trading experience, I'm seeing some of the mistakes I make, and with regards, especially with regards to market structure, and I'm trying to correct those. I have an accountability partner, but YouTube is now my other. Y'all are my other accountability partners. So I want to make sure that I try to do the best that I can, not to mislead or misguide information. I am hoping that you know. 90% or 85% of what I tell you're good on. But here is the key. This is the key. You can't rely on information from YouTube. You can't rely on that. You can get bits and pieces that are really good, but it's gonna be a basically it's gonna be a group of information. It's gonna have some good stuff in it. It's gonna have some not so good stuff in it, and that's why you have to do your due diligence to study and back test and prove or disprove what you hear on YouTube. Okay, so that's critically important. I am not a teacher. My function is a journalist, and in this experience, I'm going to teach myself for some things because that I can say I'm my own teacher because I'm willing to take responsibility for what I do, and I will try to correct things if they're not that great. Okay. I think I might have let some folks or maybe kind of mixed up these terms and I used them a little interchangeably. So that's why I want to clean this up. So, in my definition, I consider these things somewhat the same but very different, and it depends on context. Okay, so a zone, in my opinion, is an area that um, is like a range, but it's part of a trend. It's part of a movement. Okay, you can't. Both of them basically have a high and a low, a swing high and a low, swing low. But to look at those by themselves doesn't give you context. When you look at that high and low in relation to other highs and lows, then you have what we call a trend. And depending upon where that swing high and low is a zone. Okay. The range is more of an area where you can't judge what direction price is going on. It's ranging, okay? And it does have a swing high and a swing low, but it moves more up and down, and it hasn't broken out of its range to tell you in context with the other swing highs and lows what direction it's going, whether it's going bullish or bearish. Okay. So a range doesn't really give you an idea of the trend. You don't know what's going on. So you have to wait for a breakout. So this is a trend. We have a bullish move up and a pullback. Bullish move up. And this move up, a lot of people refer to this as an impulse. Okay. And then you have a pullback, and then you have a bullish move up. Okay. The range can be considered from this low to this high, this swing low to this swing high. That's the range. The zone is the pullback. Okay. So this is, as you can see, it looks like steps going up. So that's a bullish move. Dave teaches that the money is made in the pullback, and the pullback is the zone. He also says no zone, no trade. And as we get in, I'm at the beginning of this journey, and I'm kind of trying to define a little bit the terms, a lot of the terms that Dave teachers use. But my recommendation is, because as I go on, I'm just going to use the terms. And if you don't know them, you're going to kind of lose part of the conversation. So watch the videos. He is the teacher. I'm a follower. So follow him. Don't follow me. So I'm going to refer to terms and that will come from him. But now I'm just basically, because one of my missions is to make sure that I kind of explain market structure. And this is market structure. Okay. So impulse up, pull back. Okay. In this impulse move up, you're going to have an intermediate swing high and low. So once the price gets to the top of this, wherever it decides to kind of swing high in the impulse, come back, touch it, and then keep moving. This is really the same move. But you want price to kind of swing out of the zone, come back in, and he recommends roughly about a third of the way or more before slinging up and completing the impulse. So that's what we are looking at in terms of, and you reverse the same way. So when your impulse down, you pull back, here's your zone. No zone, no trade. Okay. Pull down, pull back, here's your zone. No zone, no trade. So what you're doing is you're looking for your setup in the zone. You're looking for a reversal. You're looking for a range to trade off of, a fractal to trade off. You're looking for whatever POI, point of interest, in that zone that has been confirmed, and you take your trade from there. Okay. So I hope that kind of helps a little bit. I'm sorry for the pinging. All right. The other day I said that I'm a technical trader and not really a fundamental trader, and that wasn't the complete and full truth. Let's look at what I look at in terms of fundamentals. Okay, so in NASDAQ, it's made up of stocks. Okay, and they're all market capitalized weighted. What you want to NASDAQ moves based on the biggest weighted items in that that group. Okay, so NVIDIA, Microsoft, Apple. What I do is I look at the top 6 And I kind of want to just see, well, where are they at? Are they in a downtrend? Are they in an uptrend? Because these are the stocks that NASDAQ moves on primarily. They don't move on the stocks that are at the bottom of the market capitalization chart. So they move on these. And if you get an idea, a quick idea as to what's going on with these, and all of these today show that. Let's see if I can get this in the picture. That price is moving on the downside. Okay, so that's a confirmation, and that's pretty much all I do with fundamentals. Okay. So yesterday, I didn't take any trades. One of the things that's really important is self-awareness. You need to know where your head is at before you trade. You need to know what your emotions are. You need to know what your physical condition is. You need to know those kind of things. And yesterday, my mindset and my body was tired and my mind was foggy. Okay, so when you trade, you want to have a sharp mind. You want to be well rested, and you want to be physically well and mentally well, because there's a lot of decisions that you have to make. You can't be wondering, dang, I entered the trade and I'm not really sure why I did that. Okay, so take a mindset check before you trade. Are you good? Now, I did look at the charts, and the other reason that I didn't trade is that I didn't see that a setup, and I saw more stuff that could fake me out than I could take advantage of. So I was like, yeah, it's not worth it. I'd rather be out of a trade than a trade that I wish I was out of. Okay, so very important. So I just sat yesterday out. Today, let's look at today. Let's look at what happened today. Wasn't necessarily a good day. I lost $71. Okay. And they were pretty much in back-to-back trades, $71. So it wasn't a good day. Let's take a look at what happened. Here are the two trades, okay? And this is on a 1 minute time frame. So I thought that I was in a reversal. Okay? My eyes were playing tricks on me. And this did not qualify technically as a reversal. There's a couple of things wrong with this setup. So let's see if we can map it out. Let's see this this impulse, which I started in the middle of. This low created this high, which created this low, which created this high, which created this low. And I'm going to stop there. So there's a lot of things wrong here. And I misread price action. Okay. So a reversal would look more like this. Your impulse come down, you go up, create an intermediate swing low. Then you go up, you put a body on that swing high, you come down, and then you would take off. So it looks more like a W, okay? And it's very important that a body is put on this, okay? And that this, where is it? This does not travel below the swing low. Puts a body on this swing low right here, okay? Dave talks about these in this video. And you can see how different that is. This actually came from here. Let me change this. This actually came from here. Swing down, up, down. Now see how close it is? Down, up, down. Now the difference is this right here. There really wasn't a body on this swing high right here. So if this had a body on it, and that was why I got cooked. Okay, so this here is a fail to take. Didn't take that swing high. Didn't see it. Wasn't listening with my eyes. So that's why I got cooked on that one. Okay. Then I guess you could say I thought I was right. That price was going to go up. Okay. So I entered another trade. And that trade was based on the same concept. I thought, well, maybe this time it'll go. Oh, it was bad thinking. So the impulse took it down here. So, and then price went up, came back, and went all the way down here. Those are all intermediary swing highs. I'm sorry, swing lows. Okay. So it went down there. Again, not a good entry per se. I thought I saw a putty cat. No, I thought I saw another reversal in here. But that's where market structure really comes in. You got the intermediary swing highs and lows. They tend to confuse me. And I got to really be careful with that. Because as you can see, when you misjudge where you're at in terms of the overall scheme of things, you lose trades. If you're not sure, it's like being somewhere without a map. If you're not sure where you are, then you're going to get lost or you're going to get stopped out. Now, let's talk about how I got stopped out, because it wasn't my stop that stopped me. It was my trailing drawdown that stopped me. Thank you, trailing drawdown. That stopped me. And I did not take enough time between these trades. Dave recommends that you take some time, step away for a second, maybe come back to the charts, take a look at, things again. To jump right back in a trade is typically not the best idea. 90% of the time, in my experience. But you can see here I did it anyway. But the thing that stopped me out was my trailing drawdown. And I discovered, because after I lost this second trade, I got locked out. And that's the feature that I selected. I want to be locked out if I hit a certain point, because I have a tendency to revenge trade. And typically when you lose a trade, you should scale down, not scale up. And my habits, or what I tend to do, is I lose a trade, I'll scale up a contract and kind of try to get the money back. That's the wrong method for like overall. They tell you if you lose a trade, you should drop down, not scale up. Drop down. Get the money back with a good trade and then scale up from there. So few things, habits that I developed over the years that were bad habits. Sometimes they work out, sometimes they don't. In this case, they did. All right, so I discovered after the second trade that the trade I didn't apparently fully understand how it was working. I was thinking that it wouldn't stop me out until I used up all $90, which is the amount of money that I put in for it to stop me. I thought it would use all $90. That's not how it works. So let's take a quick look at that real quick. And I know some of you, a lot of you don't have this in your let's see if I can. A lot of you don't have this in your prop firms and so forth and so on, and that would benefit you. The trailing drawdown in prop firms that use this benefits the house more than it does the individual. What they do is they let you set up a maximum stop loss, and that's kind of what I was treating that $90 as, is a maximum daily loss limit, and it wasn't working like that. So I got confused, and it took me about an hour to go over and over and over and try to figure out what math is it basing its decision to stop me out on. Okay. And I finally got to the right math. The drawdown is almost like a floor, and as your trade is increasing in value, the floor creeps up. Okay. Now, the question is, and it creeps up at a different at a level of $90. Okay. So let's think of it this way. The trailing drawdown in this case here works more like a fall. How far will the trailing drawdown let you fall before you hit your safety net? And when you put that number in, and I put in $90. Okay. So I put in $90. So it would allow you to fall $90 before it stops you out. So my trade went up to 664. I started with cash, and it's over here in the black box. I can't do that here. $611. So the trade went up to 664. The floor moved up to 573. When my trade started to come back on me, and that's right about here. When it started to come back on me, my stop loss was right down here, below this swing low. When it came down, it had used up the $90, and it stopped me out. So in my moment of genius, I said, that's not enough drawdown. I need more drawdown. Yeah, that is not the way you want to think in this game. Then I raised the $90 to $120. It's so funny. And then, I had my stop loss down here, and it stopped me out again. And I was just like, what's it doing? I just don't understand. So I had to figure it out. And over here on the second trade, my trade went right back up to about 663. And the free fall that I did there was $120. And I landed around 543. And when you look at the dollar amount that I started with, It was at a point where I don't know why it let me change it. Not sure why it let me change it, but what's supposed to happen is that when you get locked out, you're done. So this time it said, nah, you're we're gonna help you out. So that's what down here is talking about, is once the lock has been enabled and the set limit is hit, the account risk settings will not be able to change until the end of the session. So you're locked out for the rest of the session. Now, I'm glad it did, because here's the thing. I had $500 to start with in this account. We got up to 611. Okay. And in that, I made some profit. I made some profit. Today I lost $70, but I still ended the day or the week with $542. Okay. My other $500 finally hit. It takes so long. So I ended up with $542. But had it not worked, you can see I would have had, let's see, additional 5-6 points there, and I went up and I would have had an additional 10 points there. So in this trade, I was in with 2 contracts. So 2 times 7 is 14, times 2 is 28. So that would have been another $28. And this one, 10 times 3 is 30, times 2 is 60. So 28, is that right? 10 times 3 is 30, times 2 is 60. Yeah. So that would have been $88. That would have taken me into drawdown on my $500. Okay. So 70 was it $71? $71 plus 88. $159. So this program saved me minus 71, $88. Yeah, that would have been a rough start next week. So kudos to the lockout system. Now let's look at price action real quick here. Obviously, I didn't put a body on the high here and not get faked out. Look at here. I'm in this trade here, and I'm watching price make lower highs and lower lows, which is an indication that price is bearish. Now, why else did I mess up today? Well, there's a couple of reasons. Okay, let's take a look. Let's zoom out, if you will. We'll talk a little bit more about market structure. So this chart here, I did this on purpose here because I wanted you to see what that other hand drawing looks like on a chart. So here's your impulse up, impulse down. Now, if this was a bullish trend, price would go up to here, okay? Then come down into this zone, hit a POI, and then a reversal, or vice versa, and then head back up. Okay. Just make this just a little bit lower. Okay. So That's how that would look if this was a bullish trend. Let's go make it a different color. Let's make it purple. Okay. If it was a bullish trend, that's what it would look like. But what trend do we see? We see a bearish trend, right? Goes down, pull back. Here's your zone. That's where you want to take your trade. Goes down, comes back. Right here, right in here. This is an intermediary. So what's happening here is, mark over this. That. I want a different color, and I also want to make this chart a little bit larger. Okay, a little bit larger. I'm going to try to map out the highs and lows here. Okay, so this low here is responsible for making this high. This high is responsible for making this low. This low is responsible for making this high. See how I'm doing this? This high is going to make the next low. Okay. So that is that's how you map out your trend. Now let's look at where I took the trade in the trend. And obviously you want to find your POI, and you want to find your setup here, and then take your trade down. It's following market structure, which I didn't do. Had I done that, I'd be doing a different kind of recap right about now. I want you to notice I was in the zone, but I was trading against the trend. Some things really need to change. All right, so I was trading against the trend because I took these two longs. Here's the other reason why I got cooked. Let's go over to. I took trades before I did my top-down analysis. Okay, so before you take a trade, you want to try to draw out your trend. Okay, and if you're drawing a trend that looks like this, guess what? You know to stay out of that, right? If you're drawing that kind of a trend, you know to stay out. That's a range. Unless you're a range trader. Now, if you're a range trader, you're fine. In fact, you're probably happy. I know where to get in. I know to get in on the edges. Buy low, sell high. Buy high, sell low. If you're a range trader. But if you're a trend trader, and that's pretty much where I am, it's easier to trade with a trend. And listening to my own words. Why don't you trade with the trend instead of making a counter trend trade? And the reason why I did that is because I didn't know where I was in the market structure. I didn't know where I was. I didn't take the time to really do my due diligence on figuring out where am I? Where am I? If you know where you are, you can figure out where you want to go. If you know where you are. Take a look at this. I'm in the zone, counter trend. And let's go out. Let's go down a little bit. Let's go down and see if we can go out a little bit. Really didn't need to do that. All right. So let's just look at let's just put it on fib. So the zone, I was in the impulse when I took it, because here, take a look. I'm still in the impulse right here. Took the trades in the impulse. I did not take the trades in the zone. Another reason why I got cooked. So I'm in the impulse really. I got kind of twisted up with intermediary highs and lows, and yeah, that's what happens. Now, here's the actual zone. This is it right here. This range right here is the real zone. Okay. So price comes up, comes out of the zone. This here, candle here. I don't know if you can see that or not. This candle here taps the zone, continues down. That would have been a nice little trade. Dave would have taught, take a look at your trade down here with the right confirmations. And so if you got in down here, back of the zone is where you would, try to see somewhere back here, figure out where your place stop would be. Take that short. And it's trading with the trend. Okay. So that's why I got cooked. Didn't know where it was in market structure. And didn't figure out the right place to get in. So that's what happened. Next week, I got to do a better job. So, and after you finish your top-down analysis, say it this way. After I finish my top-down analysis, my next plan is to draw out the trend. And, it's obviously bearish, right? I mean, look at this. It's obviously bearish. And once again, this is this week's lesson. I'm under the 200 simple moving average. So here's a confirmation. Tell me, stay short. Stay short. You're better. That's a higher probability trade. Let me see what else. Now, you may be asking, and we didn't really look at the account spreadsheet tracking where we are and what we did, how we did for the week. This week I had 3 dubs, so I'm very happy. And keep in mind, I don't define a dub as winning money. That's not a dub. If I lost money and I read price action correctly, I was in the right mindset, and what you're going to lose, right? It's not, even if you make all the right decisions, doesn't mean that you're going to win every trade. So I was in the right mindset. You got to look at what did you do right? What did you do wrong? So here's my analysis that I wrote after I took trades. Here, and this analysis here, it's gonna your bias is gonna be, are you long, short, or neutral? Okay, for me in my spreadsheets. So in this case, shorts. That's what the analysis would have told me to do. Stick to that. Now, you don't have to marry that. I mean, if you have really good reasons to take a long. Sometimes price, sometimes news, sometimes something happened. NVIDIA could have came out with a new AI chip that was booming and just the newest hottest thing in the world. And then NVIDIA starts taking off up. Oh, your trend. Then price will be breaking the bearish trend and now it's bullish. So that can happen. And if that's the case, read the price action, have really good confirmations to take that long. manage your risk very well. Counter trend trades, if you do that, based on my personal experience, should not be the on the top end of your contracts, number of contracts. Going with a 1, so if you lose the trade, something happens, you misread it, and it's counter trend. Counter trends you typically want to get in, not swing the trade. You want to get out. You want to keep your eye on where you want to get out. So looking at, I should have been in shorts, and then I took, and this is the reason why this area is important. Did you listen to your analysis? No. Okay. So let's go back to why I gave myself a dub. And I think it's very important to remember that if you focus on the positive will come. You don't want to focus on the negative. So I try to give myself a little bit more weight for the things I did right than the things I did wrong. So the things I did right, I accepted the fumbles and the losses. I didn't, beat myself up. I didn't call myself names. I didn't, just berate myself. It's like, you know what? You fumbled. Move, that's the past. Nothing you can do about it. You can't change the past. Regroup, move forward. Okay. So I accepted the losses and the fumbles, and I learned from them. And I hope that I will put what I learned into practice the next times I run into it. So we'll see, because this is a journal. We're going to go till we either hit 3,000 or I blow the account. So after losing those, since I didn't understand what was happening with the trailing drawdown, I really wanted to make sure I understood how it was calculating things. And now that I know how it's calculating, then I can have some comfort and confidence in what it's doing and when it stops me out. Okay. And I already talked about the things that I really didn't do well. I'm going to grade today as a draw. Overall, I'm going to grade it as a draw. I didn't win. I didn't lose. I got a D, a draw. So that's what we're going to put in here, is a D. D for dummy. Anyway, so over here, my contracts, kind of need to keep an eye on that. If you lose one, you should scale down. I should have went down to one contract, mitigate those losses. TP hit, no. Can't wait to put a Y in there. Traded during the London session. In terms of our accounts are going pretty decent. For some reason, I had some technical difficulty with my copy trader, and these 5 accounts didn't experience that $71 loss, which is cool. It's good. I don't want to have that experience if I get a banger, but these accounts are fine. It was these accounts that suffered. This one here, as you can see, if I spend $88 on a trade, that's it. That one's gone bye-bye. The ones in green are funded. So that's it for this trade recap. See you next week. Next week, we're going to kick some butt. We're going to make some things happen next week. So let's go.